Hi, Jeremy Tyler, Certified Financial Planner Professional here in Springfield, Missouri. Coming to you today, we want to talk about how the winds are changing in the stock markets, specifically the S&P 500 as well as the NASDAQ. There's been a lot of volatility lately. There's some charts that we want to pay attention to. If there's one thing I've learned over the years, watch the charts, don't pay attention to the news or the headlines. So let's dive in and take a look. In the first chart, we're going to look at the S&P 500 and the fact that it has lost its upward momentum. We have indicated by a circle here, this is the two candles, the red one and the green, showing that it is now outside of this parallel trend. The red line, the upward sloping red line, has been a range that the market has traded in for over 2 years now. We don't go back that far in this chart, but you'll notice what we're looking for is 1 day to trade, so from open to close, outside of that parallel trend line. This red bar has done that, and the green one is actually the bar for today on Wednesday. So we now have confirmation that the S&P has lost its bullish bias, meaning trading to the upside, and now could begin to take on a bearish bias. In the second version of the S&P 500, let's look at levels. So if we do enter this bearish type of market fill, what are the levels that we're paying attention to? I've indicated here with 2 black lines. We're just going to keep a near-term viewpoint. So 577 is where the market sits today as we record this video. And you'll notice where I've put the blue arrows is price points where the S&P 500 tends to gravitate to because everything is traded by computer algorithms. So 2.02% below 577 puts us at $565. That's a point that we're very close to, that we would expect the S&P 500 to reach. But really more so that we're looking for that true pullback would be 9.34% below here, getting down to about 525 or so on the S&P 500. If we get to that level, I think that it's pretty obvious at that point we're in a bear market. So in the next chart, we're going to look at the NASDAQ, the tech stocks, NVIDIA, Google, Microsoft, all those good fun names. The black line on this chart represents what we call the 200-day moving average. Very seldom does a index touch the 200-day moving average without that being a major turn of events, whether for the good or the bad. We are currently, today again, March 5th, sitting below the 200-day moving average on the NASDAQ. This is a day that Trump's talking about tariffs, and of course tariffs are going to be all the talk right now. But if the NASDAQ closes below this 200-day moving average one day, that indicates that we are in a bearish type of situation for tech stocks as well. There's plenty of negativity to go around for them, so I fully expect that to happen, if not today, in the next few days. So let's take a look at the levels on the NASDAQ chart that we would be paying attention to. First level, again, is also just slightly below where we sit. 18,350 is the value of the NASDAQ today, again on March 5th. 2.2% below there would put us at roughly 17,944. But more so, again, we're interested what would be a more substantial pullback. This just kind of puts us back to the normal zone that I would expect to trade in. So an 11.34% drop would put us back to 16,268. That's a number we're really looking for. I think tech stocks are grossly misovervalued, as we've talked about numerous times over the last 6 months. Things are just kind of coming to fruition here all at one time, and of course it works out well that they have someone new to blame that on, and Trump and his tariffs. So that's what the narrative will likely be for the near term. So let's address the elephant in the room. Why are we trading so much, right? I get people saying, I get so many pieces of paper. So for one, if you're on paper statement delivery and you have your trade notification set to paper delivery, every time I buy 1 share of any stock, you're going to get a piece of paper. So our first recommendation is for anybody that's getting trade notifications to consider at least setting that up electronically so that it's just an email that comes out. That's a Schwab thing. For those of you who have been around a long time, which many of you have, TD Ameritrade did not offer trade notifications, which was great. It works well for somebody that's an active investor like us. But when something comes up that is a good buy or a good sell, and we need to trim a little or add a little in an effort to make our accounts do better, if it generates the paper, it generates the paper. I apologize for it, and I know it aggravates some folks, but I would consider maybe reaching out to Sarah at the office and seeing how you can set up electronic trade notifications so that you don't get all of those papers every time we trade. So let's revisit our core investment thesis right now and how that can affect the amount of trades that we're taking. Interest rates are all over the place, right? One day inflation's up, supposedly down the next day. All of this can happen within 24 hours, and bonds will ebb and flow with that news. We're building a large bond portfolio, but one never wants to buy all of their investment in one day or 1 week. So every time I buy 0.25% of our two core holdings, SCHQ or PYLD in our investments, those are our conservative bond funds. Every time we buy even 0.1%, that generates that trade confirmation. Now, let's talk about something on the other side. Like, our core thesis does remain to buy bonds and to be short certain sectors. Certain sectors right now we've been short tech, which you'll notice our accounts have done. The best that we've done over the last 45 days is really the best run we've had in a little bit, probably a quarter. But shorting banks is our second thesis. Buy bonds and be invested for the banks to go down. And reason being is this graphic that we're going to pull up now. So you'll notice on this graphic, this is showing the unrealized losses that our banks have on their balance sheets. And really the main thing here is in comparison to 2008. You remember the great financial crisis and how much our accounts went down back then. Ours didn't, but some did. In 2008, the losses that they had are minuscule compared to what they're floating with now. And this is something else that has been covered up with government liquidity and through the FDIC and various agencies. But this is a big threat, and the banks are at all-time high valuations, so we remain short the banks for this particular reason. We are long bonds. So why are we long bonds? We know why we're short banks. We're long bonds. We want to own a lot of bonds. If there's a recession or any bad employment number or the Fed cuts rates or any numerous things, bonds will go up a lot, and we will still continue to get the high level of interest payments they're paying us. So we welcome any bad news. We really do, when we have for some time. Now let's talk about some of the positive things, right? If you'll look in the email content today that Justin's composed for us, you'll see that bonds can go up quite a bit during these recessionary periods. But during recessionary type periods, there's a lot of stocks that are really cheap. There's two that I would like to point to in your portfolio. Seadrill, which is ticker symbol SDRL, has been absolutely beat to death over the last 18 months, down like 60%. And during the most recent times where we've had these pullbacks, we've started to buy that. And I've had to buy it like 5 times because it'll go down 5% a day or something and generate more trade notifications. But I want you to notice how cheap we're buying these stocks, because we're buying things that we will be able to hold for a long, long time. Seadrill's one. Noble Energy Corp, which is NE in your portfolio, is one that we've had to buy numerous times that also is down over 75%, pays a 7.5% dividend. It's a real nice stock. And lastly is coal, ticker symbol COAL in your portfolio. Trump has been very boisterous on his love for coal, and coal stocks such as AMR, Alpha Metallurgical Resources, that's the #1 holding in our coal ETF, is down like 70% over the last 2 years because the previous administration did not like either of these sectors. We're getting some great long-term buys. Our accounts are heading the right way. And I think that things are really looking up, and we appreciate you guys staying around and putting up with all the trades.